Now, we want to get into the main thing itself, which is the GDP. India is just marginally below $4 trillion. And at the rate India is growing, especially over the last few years, we can see that India is coming hot on the heel of Japan. And this is something that we have to watch, because this year, India has officially overtaken the United Kingdom as the fifth largest economy, and it is basically coming for Japan. So we can see India is definitely a growing economy, and we all knew that India right now has already surpassed China as the largest country in the world in terms of population size. And this is going to allow India to actually reap the dividends of its young population, because in any kind of economies, not only as consumers but also as a measurement of their workforce, a young economy definitely will be able to catch up to the rest of the world. Now, when we look at the internal structure of India, going back to 2013, you can see that the Indian economy has been averaging very, very good, above 5%. And that only took a dip in 2020. We all knew what happened in 2020. You can see that the following years, India economy goes into a tailspin. It actually registered a negative 5.8%, but it bounced back very, very fast. We can see before pandemic, India GDP on the yearly basis, on an annualized basis, has been growing at a very fast clip. Now, this reminds me of China right after they entered the WTO, and we can see that China also progresses very, very, very fast. It basically tripled the size of the economy. So it looks like India is replicating what China is doing based on their GDP growth. And we can see the rebound from the pandemic itself has been very robust. It registered a high of 9.7% in the whole of 2022. And of this year, we are only we're not even at the end of Q2. We're almost at the end of Q2 at the end of this week itself. And already Indian GDP, based on the data that we see, is likely to register an annualized growth rate of 8.2%, assuming the second half of the year is just as good. So if momentum maintains at the current level, there's a very good chance that India may actually register 8.2%, which is very, very good. You can see based on the growth rate between India and China, you can see India has a lot of potential. And of course, this has got everything to do with geopolitics and the trade war between the collective West and China. So that is having a negative impact on China. Whereas I think India is taking the opportunity to do a lot of catch up, because there's a lot of de-risking going on. There's a lot of companies they are moving out of China, either for political reason or for other factors. They are shifting to other markets, and India is a major recipient of this inflow of what we call the FDI, the foreign direct investments. Over here, we can see the major contributing sectors to the Indian GDP growth. You can see the large one, the outliner here is construction, and construction means infrastructure. So India, from that perspective, has a lot to build, because unlike China has been growing phenomenally due to infrastructure building, and India, by comparison, is coming from a very, very low base. You can see by extension, the rail system is still very much on steam engine, and we can see that the ports buildings are not as advanced as those in China and the others part of Southeast Asia. Now, the other one that will continue to grow will be manufacturing, as countries are shifting their base to India for manufacturing, whether it is to build microchips or whether it is to build tech equipments. Okay, we can see that there's a lot of Western tech companies are beginning to set up their presence in India, and this is actually going to work into the manufacturing. Now, the other one that is also very prominent is agriculture. We all know that India is very much an agricultural economy, and most of their production is still based on domestic production of food. Okay, so that will remain to be seen, will remain to be prominent. Now, the other one that also stand out is public administration, meaning to say that the size of the Indian government is actually growing, and I won't see it as a good thing, because if the size of the government continue to expand at the expense of the other critical sectors, it may actually be a drag. Now, a good example would be United States. The the portion of public administration, meaning to say that the portion of the size of the government relative to the overall GDP for America is actually very big and it's growing. Okay, month after month, we can see that their non-farm payroll is very healthy. Deep into those numbers, we can see that a quarter of new jobs creation in the States is actually government jobs. So this is not good over the long run, because if the size of the government gets too big, it becomes a drag on the economy. So right now, based on the information that we see here, we can see that 60% of the growth in GDP is actually related to services, and which is very, very similar to mature economies like London, for example, and the United States. But you can see that the one that will really actually anchor in the economy is manufacturing. So there's a lot of scope for India to catch up on manufacturing. Okay, now these are the future growth sector in India. Okay, so we'll start with the first one, electric vehicles. Now, India automobile industry is still very much catering to domestic consumption. The biggest, most prominent automaker is Tata, and they don't build anything like what the Chinese are building, which is they have gone almost fully electronic. Okay, meaning to say that this is a sector that will have a lot of potential, because to pivot from gas powered automobiles to electric vehicles, which is going to be the trend going forward, and we can see that this one has a lot of potential because they're coming from a very low base. The entire Indian EV markets was valued at about $1.45 billion just 3 years ago, and it's expected to 10x this number, okay, by the year 2029. Then, of course, the healthcare and insurance market is also growing. Okay, it has reached a size of about $372 billion 2 years ago, and at this compound annual growth rate, which is CAGR of 22%, is expected to continue to grow and grow and grow. Okay, so right now we can see that this is expected to grow another 20% by the end of 2025. The other part will be renewable energy. And now this is a common theme. When we look at EVs and as well as renewable energies, we are all talking about going green. So we all know this has been a major theme. China took the story of going green and actually scale it up to the point whereby they now are the major producer of solar panels, clean energy, as well as in EVs. Whereas on the other hand, the West campaign on going green, but they have done very little. So if this trend of going green continues to be a major topic for the global economy, India is also the part of the growth story here. So we can see that as far as renewable is concerned, that India has a lot of potential, because they have not gone in very big way, because they are still very much depending on coal and fossil fuels to power their industries. And you talk about hydroelectric plants, going to build nuclear plants. India has a lot of potential. And of course, the mainstay of the Indian economy has always been information technology. We all know India produced a lot of engineers in this sector here, so much so that they have an oversupply of engineers in this sector. Now, the other two major sectors that will also be seeing good growth will be what we call fast-moving consumer goods. Okay? And of course, infrastructure we covered earlier on. Infrastructure is not very focused at this moment in time. It has a lot of potential to grow even bigger. So like I say, the roads and the rail system is still very much not in congruent to an advanced economy. Okay? Now, this is the report that just came out a couple of months back by Deloitte. See that the GDP in the India market will continue to expand. You can see that this is a forecast all the way until Q4 of 2026, which is 2 years from now. So you can see that this is an upward trajectory, which is likely to continue to go forward. And of course, all projection will be based on assumption. So here we have three major assumptions, one of which is the Federal Reserve will cut interest rates twice this year. And this is still not big in the oven yet. But this projection is based on the fact that Federal Reserve will have 2 rate cuts this year, and this will actually narrows down the gap between the interest rate differential between Indian interest rates as well as the American interest rate. So right now we have 4 major central banks that has already pivoted. Everybody is waiting for the Fed to do the next cut. However, we are now in June, and it looks like the Federal Reserve had decided that June is not a good time for them to cut interest rate. So they left their interest rate unchanged. And this is actually impacting the other major economies in a big way, because unless the US cut interest rates, the capital flight is going to flow to the United States, because we all know the situation in which the US is operating under. They are definitely in need of tackling their twin deficit. Not only are they talking about a budget deficit, meaning to say that the taxes they collect is insufficient to cover the expenses to carry out all their programs. Okay, so there is a deficit in the budget, and of course we all know that US has always been the biggest export market to a lot of economies, and it means that Americans are buying more rather than selling to the rest of the world. So that creates a trade deficit. So what we call the twin deficit in terms of the budget as well as the trade deficit is concerned, unless the US starts to cut rates, money and capital will continue to flow to the United States. So we can see emerging markets this year has been on the rope, very much in the fashion of what we saw back in 1997. Now, if you remember 1997 is where we have the Asian financial crisis, because currencies of the emerging markets actually collapse. And right now we are seeing almost the same scenario, because emerging markets, whether it's Lebanese pound or Egyptian pound or Indian rupiah, and as well as Indian rupee, we can see that they are all being coming down very, very aggressively. And if this is not arrested soon, and all the hopes are actually banking on the Federal Reserve cutting rates soon so that they can take the pressure off these emerging nations, what we call currencies. The next window for the Federal Reserve to actually cut will be next month. The next FOMC meeting, which is the Federal Open Market Committee, is going to be held at the end of July. And if they do not cut by then they will not be able to cut until September. And September is only 2 months away from the US presidential election, and this is cutting it a little bit too close. So for all we know, this assumption here may be wrong, because the Federal Reserve, if they don't cut soon, then they may not have time to cut, because if they cut too soon near the election, they may be seen to be trying to influence the outcome of the presidential election. The other assumption is that crude oil prices will remain affordable, meaning to say remains below $80 per barrel. We can see that crude oil prices has been coming down since the start of the war in Ukraine, and a lot of that has got to do with the US releasing a lot of their stockpile from their strategic petroleum reserves, and that has kept prices low. Okay, and based on what we can see, crude oil prices has been on the rise. As of this week, as of last time, we can see that crude oil prices is back above $80 per barrel. And if crude oil prices in terms of the WTI, which is the West Texas Intermediate, continue to rally beyond $90 per barrel, this assumption will have to be revisited. Okay, there is a good risk that oil prices may stay elevated for a long time, because when you have conflict areas like concerning major oil producing region, then of course the pressure on energy products will actually go higher. Right now we have an ongoing war in Ukraine, and we all know Russia is a major producer of crude oil and natural gas, and of course there has been trying to sanction Russia in terms of not allowing them to export their energy products to Europe. But you can see that will impact Russia negatively. But overall, we can see that there's a pressure for energy prices to rally. And the other conflict zone, of course, is in the Middle East. We already knew that the war in Gaza has been ongoing for quite some time now. And we can see from July, August, now we are almost into the 1 year anniversary of that. So we can see that if the war in both conflict area in the Middle East as well as in Eastern Europe do not end soon, it will have a negative impact on energy prices. So in my opinion, I think it's quite logical to expect higher energy prices going forward. And of course, India would have to maintain a tight monetary policy, meaning to say that in order not to have Indians sending money overseas, because right now when we look at Indian interest rate, is actually higher than the Federal Reserve interest rate by 1 whole percentage point. And the whole idea here is to make sure that capital do not leave India for United States, because everywhere else you can see that the attraction of parking money in the US dollars is actually very, very strong. So much so that there is a worldwide shortage of dollars right now, and that's only allow people to actually buy more dollars to be parked into US Treasury. And this is actually seeing a global shift in capital into the direction of New York. So this is also one of the reasons why regional currencies has been so weak, because of the interest rate differential here. Okay, so Indian trading major partners, you can see of the total trade that India trade with the outside world, a good chunk of them, more than 50% goes into these few regions. One is European Union, accounting for the biggest pie of their export. So India trades a lot with the European Union, especially after the war in Ukraine. Later on, we will also talk about how the war in Ukraine has actually materially affected India's trade with Russia. Okay, the other major portion is ASEAN, and a good chunk of their trade is actually with Southeast Asian nations. And of course, we also have China being also taking up a good chunk of those, even neck to neck with the portion for the United States. So India trade a lot with China as well as with the United States, almost equal portion. We can see that China is just marginally ahead of US in terms of export. Okay, and the other one in the Middle East will be with the United Arab Emirates, UAE, followed by Russia. And Russia is largely due to energy imports as well as military purchases, because India buys a lot of war machines, okay, from Russia. So we can see these are the major trading partner of India. So it is highly unlikely that this composition will change anytime soon, and this is actually growing. Now, earlier on, I did mention that India imports a good chunk of oil from Russia. Now, this is not a case before 2020. Before 2020, we can see that India actually import less than 1% of its energy needs from Russia. But that all changes at after the war in Ukraine started. You can see that the West has actually embargoed Russia in terms of not allowing them to sell their oil to Western Europe, in particularly their natural gas. And the one that we can see that India has found an angle to actually arbitrage this sanction on Russia. What Russia did was to buy all this sanctioned oil that Russia used to export at major discount, and then bring it back to India to do some refining. And then, of course, they add in other crude oils from other places like Saudi Arabia and Malaysia, for example, and they mix those oil up, refine them, and sell back to Western Europe at a premium. So we can see as of now, India imports of Russian oil accounts for 40% from almost nothing. Okay, so you can see that the impact of the war in Ukraine is actually benefiting India in a very, very big way. And not only is India doing that, US is also doing it, ironically, because they are the one that impose sanction on Russia. But the Western Europe are not able to buy or rather not be able to access this relatively cheap natural gas from Russia. Now they have to buy it from a third party like India or even United States at a premium. So you can see that this is negatively impacting the European Union. So earlier on, I did mention, right, India right now ships about 5 million barrels per day. Just last month, okay, that is a growth of more than 5% month over month. In April, they shipped out something like just under 4.5 billion barrels. Now, inflation rate in India obviously is following the same trajectory as what we are seeing in the rest of the developed world. If you look at this time last year, India inflation internally is 7.4%. Okay, the most current numbers that we have, which was last month, was only 4.75%. So you can see it has come a long way. We can see that inflation, the headline CPI numbers, year over year is heading down. But we can see that also very similar to what we are seeing in the major economies, that the gradient has actually slowed down. In fact, it's showing sign that it has plateaued and getting ready to rise, which is the case that what we saw across in Europe as well as in America. Now, will that be the one catalyst that will not allow the Federal Reserve to cut rates fast? That could be the case, okay? But we will have to watch this situation going forward, okay? Because inflation, though, has come down quite a fair bit, but it is still very stubborn. Most of the major central banks are looking at 2% inflation rate. So if you're based on 2%, and I'm sure the Indian central bank will also be using the same yardstick to measure when they can actually cut rates. Okay, right now interest rates are relatively high, in excess of 6%. Okay. So this one may have very little room to improve going forward, and that will mean inflation will remain a major concern for central bankers. Now, this is the wholesale price. Now, wholesale price, you can see, is a measurement of the input cost of manufacturing. You can see that has been pointing upwards. Whether it is food, fuel, or manufacturing, they are all pointing basically in the same direction, which is up. Okay, and this will eventually find its way into the CPI numbers because input cost goes up. So based on the wholesale price we can see so far, it is definitely not a good sign for a lowering of inflation in India for the time being. Okay. So this is the current interest rates. Very much like the United States and the Federal Reserve, you can see that interest rate has stayed stable for more than a year now. At the beginning of last year, it was 6.5%. As of now, this month, it is still 6.5%. So this is deliberate because the Reserve Bank of India, which is the central bank of India, cannot lower rates until the Federal Reserve lower rates. Because if they don't, then capital will flow out of India into the overseas. So I think the Reserve Bank of India is definitely taking its cue from the Federal Reserve. So this is the latest news that came out this morning. It said India external debt stands at $663.8 billion at the end of financial year in March of this year. So we can see that this is not a big number. When you talk about major economies, India, after all, is the 5th largest economy in the world. So they're considered big major economies right now, although they are still categorized as emerging economy. You can see that $664 billion is nothing. When we look at the United States, their national debt stands at just under $35 trillion. So we can see this is, two different categories. So that put India in a very, very good position because even though there are signs that this debt, external debt, may increase over time, but based on what we've seen so far, this is actually a reduction based compared to last year. You can see that based on their overall debt load, you can see the external debt to GDP ratio is only 18.7. This is not even 20%. Okay, whereas the rest of the major economies are in excess of 100%. So we can say that is the situation for major economies. India, based on the debt to GDP ratio is less than 20%, allows them to actually expand their balance sheet if they need to. Okay, but I think they are very, very prudent. Physically, I think they are very well managed because they do not have excessive debt. Okay, so we can see that this may actually increased. At the end of last year, we can see there was 19%, now it's only 18%. So there is actually a small shrinkage in the external debt in India. So that is the reason why the Indian equity market this morning rallied to an all-time high.